Welcome to Private Equity Profits. Clifford Locks is a certified board of director, a trusted confidant to CEOs, C-level exec, and high-potential employees to help them clarify goals, unlock their potential, and create actionable strategic plans. Seth Greene is the nation's foremost authority on growing your portfolio companies with direct response marketing. He is the founder of the direct response marketing firm Market Domination LLC, and he is an 8-time best-selling author who has been interviewed on NBC, CBS, Forbes Inc., CBS Money Watch, and many more. Cliff and Seth interview top players in the financial sector, focusing on private equity firms, venture capital companies, and family offices, discussing developments and trends shaping the industry. These experts will share with you how they've grown their businesses and increased profit, and how you can too. And now, here's your host, Cliff Locks.
Welcome, everybody, to another episode of the Private Equity Profits Podcast. I'm Cliff Locks, your host. Today's guest is Sean A. Miller, the Chief Investment Officer and Portfolio Manager of Miller Asset Solutions, an unconstrained and opportunistic investment manager. His primary responsibilities are both research and the implementation of investment ideas. Mr. Miller started Miller Asset Solutions in 2010. Sean, thanks for being on the show today.
Thanks for having me, Cliff. I look forward to it.
Tell me about your background and how you ended up in the financial world.
Well, I went to undergrad at Denison University in Ohio, but I'm from Charlottesville, Virginia, which is where the University of Virginia is. And frankly, there are days I wish I'd gone to UVA. I did get into UVA, but I wanted to go to Denison to really get out of the area. And it was a great liberal arts school, and liberal arts is a great entry into generalistic investing. So from Denison, I got a job at Sanford Bernstein, which was at that time an independent investment manager, but as of April 1999, they combined with Alliance Capital Management. That's about the same time when I left Bernstein. I joined them in about 1995 after my graduation. But they really were responsible for engendering my interest and skill set and training, what I would call deep value investing, prior to being taken over by Alliance Capital.
What was it specifically that drew you to investing? So
my dad he passed away in 2004, but he was a Harvard Business School grad as well as an orthopedic surgeon here at the University of Virginia. And he had always said to me, people really care about two things in life, really their health and their money. You should choose one. And so not being a doctor, I obviously adroitly chose money, the money path, as opposed to being a physician. I was in the medical path for quite some time in college, but it just came to pass that in investments and really caught my interest more than it.
Well, getting through pre-med, I want to salute you for that. I mean, you've got a very, very high level of capability and competence.
Yes, there were some courses that really went well and some that did not. And so they were very tough, but investing really has drawn my interest ever since then.
Very good. My listeners may not realize that I'm an emergency medical technician, and I consider it a hobby.
Excellent.
Something I enjoy doing.
That's great.
What are your basics regarding investing, and what do you see as the foundation of sound investments?
So I really believe in the tenets are building a portfolio through time, where you really are allowing the investment ideas and investment opportunities to come to you. Some might call it time arbitrage or time opportunity. And you're really just waiting for essentially periods like this of market distress, where you can find opportunities where the price is dislocated from the value of the security. And I'm happy to go into other ideas, maybe now or later on, whenever you'd like. But the tenets of my investing really taught to me through my experience at Sanford Bernstein. And then I also helped manage about $450 million of assets at a local bank that also had a hedge fund here in Charlottesville, Virginia. So those were my primary training before I went out on my own, but really being a bottom-up manager as opposed to a top-down manager and focusing on capital allocation versus asset allocation. And I'm sure many of your investors and listeners know, but bottom up means you're really researching and selecting one security at a time and adding it to the portfolio, as opposed to arriving first at an asset allocation of, say, the standard 60% equities, 40% bonds, and then investing in primarily mutual funds from the top down. That's not what I do. I invest in individual securities from the bottom up. And then capital allocation would be really deciding the prudent way to invest a limited amount of capital, as opposed to taking all of your capital and investing it in a set asset allocation. So capital allocation really generally relies on a heavy use of cash or short-term, almost risk-free instruments to be your anchor to windward, as opposed to any large allocation to intermediate term or even long-term fixed income instruments.
What are the challenges and pitfalls associated with investing, and how do you overcome them?
So a lot of the pitfalls are obviously being able to go through periods of volatility like right now and avoid the urge to do something. So being able to quietly read and sit in a room and make decisions that are not highly dependent upon frequent trading are one of the best things you can do during times of volatility. It doesn't mean that during times of volatility there's nothing to be done, but you just have to overcome the urge to really just trade the portfolio for the sake of doing so in really stressful times like we're going through now. I'm not a big hunter, but being in Virginia, I would liken it to any kind of hunting that some might do, whether it's duck hunting or deer hunting. You really just want to wait for your opportunities to come to you, where you're not forcing any opportunities. Hopefully during times of stress like we're seeing now, you've done all the research necessary to implement your best ideas with the cash you have available. And so you're not being forced to be a provider of liquidity in terms of selling current assets. You'd rather be you'd rather really draw down your liquidity when the price and value during times like these are really disparate. And I really do think we're nearly at the time of maximum pessimism, with the market being down 20% or so. History has shown that beyond market being down 20%, the odds of it being greater than that are really, really fairly low, especially given the health of the U.S. consumer and corporate balance sheets and the like. It is highly likely that we're nearly at the height of maximum pessimism in the market. And other ways I'd say you really have to deal with market stress and find opportunity is know that most of the companies that, as long as you've done research, most of the companies, investable companies that you find really can be had during times like these, because really market volatility really makes the best time to invest in companies you've previously identified. And so you can use really the tools you have at your disposal, which are really the three tools any portfolio manager has that they can express skill through is market timing, which is very difficult. And that's the ability to buy low and sell high. The second is through security selection. That's the second way portfolio managers can show themselves. And that remains to be seen over time, how a manager does, and can be seen through their historical performance. And then finally, the last way is through portfolio construction, namely through position sizing. And so those are really the three ways that you can interplay at times like these of high volatility and market stress to really have your portfolio shine and illustrate better returns going forward.
Yeah, I can see our listeners would find a lot of value to work with you on a one-to-one basis, because you listen, you put a portfolio together that actually matches up with their cash flow needs, And we understand the volatility. It's just the nature part of the market. The market had a nice run up. Now it's pulling back. It's fine. It's very natural. We know we're in inflationary times. My next question is really about, are there recession resistant assets? And if so, what are they?
Yes, I believe, I'll name really three, two of which are essentially the same. So title insurance, if you've ever purchased a home or refinanced a home, which I'm sure many of your listeners and investors have, title insurance is a mandated requirement when you purchase or refinance a home. There are really two providers, publicly traded providers, Fidelity National Financial and First American Financial, that represent the duopoly of title insurance in the nation. And both of those have yields from dividends that exceed, as of this morning, that exceed the 10-year treasury. So you're getting paid north of 3.5% to own these securities where their main line of business is mandated by the US government. And so their earnings are steadily increasing, essentially at the rate of home growth and refinance. So as interest rates increase, obviously, that's going to put a damper on the refinancing business and to some degree on home purchases, but we're way behind in the US on providing for homes. And so home growth is very likely to continue. And so what they are is it's really a recession-proof way to capitalize on the back end of real estate, as opposed to buying an actual home builder like NVR or something that has truly volatile earnings. The title insurers are really just more mid-cap, not 100% recession-proof, but very recession-resistant ways to invest. The other security I'd mention is a stock like Corning, symbol GLW, which most people, may think of as their mother's bakeware, but in reality, they have a wonderfully diversified business. Between a lot of people know them for the Gorilla Glass they provide for Apple in their phones, as well as tablets. They also provide a lot of life sciences glassware, which was important in getting all the medicine out for COVID. So it was a decent COVID play. They also produce catalytic converters in vehicles, as well as fiber optics. So it's this wonderful company that is more like a mid-cap company that's slightly under-researched, that also has great future opportunities within it. And that's a fairly recession-resistant business, just because it's diversified nature in everything from technology to bakeware and medical vials and the like.
Yeah, that fiber optics, we're going to see an enhancement in that because we're going to,
no question,
that backhaul of that data set that's going to come out of, our newer technology is pretty exciting because of the bandwidth increases. They're going to end up laying more cable. And a lot of that cable is running on the side of the railroads throughout the United States.
No question. I also own Charter Communications, which is basically the cable provider, south of North Carolina and over to Texas. Mother-in-law lives in Florida and she has Charter. And, that's the only time I get to experience it because I live in Virginia and this is Comcast country. The cable providers truly are the railroads for various reasons of today.
They definitely have some pricing power. I've seen the pricing going up. Atlas came in and really raised some prices here.
Absolutely.
And they're trying to get to gig service. So we're seeing that bandwidth. They're offering more at a premium price, and I can't fault them for doing that.
That's right. But you're absolutely right. They lay the cable beside the railroad tracks because of the easements and because the depth doesn't have to be as low as it does in commercial or residential neighborhoods, and it's just easier to lay along railroad tracks.
All right. Thank you for sharing that.
Yes.
Tell me about your process of due diligence and how do you simplify the process while still executing at a high level?
So our due diligence process is fairly straightforward. We don't, in terms of security selection, we don't use any funnel process or screening process. It really, we're lucky if we discover 12 to 15 new ideas a year. And so our turnover is very low, but we have to turn over, in an overused term, we have to turn over a lot of rocks to get to that 12 to 15 ideas. And so the way in which we do that is really reviewing. A lot of people have confirmed that they are reviewers of 13Fs, holdings of other managers, as really a back-end way to research securities that other managers have purchased. That is really our first look in terms of where we begin our research process. And then we make the securities our own, depending on what their balance sheets and income statements look like. So we want to weed out the companies with really high debt and leverage, and really go for those companies that have high returns on invested capital and free cash flow. So
investing. Okay.
And I don't, I wouldn't say that we're absolute cloners, but in any kind of business, you really want to look to the ideas of the best people as a starting point. And there's no shame in that, right? I mean, many attorneys and musicians, like, Mozart would look to other musicians in terms to capitalize and how to really form the basis of his compositions. And I'm not comparing myself to Mozart. I'm just saying it's a reasonable way to go about research.
The flow of money, that's
Yes.
really what moves the market.
Exactly. Right. Why not stand on the shoulders of giants? Really, because there really is no, and of course everybody knows this from Warren Buffett, there is no added complexity. You don't get extra points for added complexity in an investment. So if you earn a return on a simple idea, it's the same as earning a return on a very complicated idea. And so why not really look at the best ideas of managers that have proven themselves? Plus, we're a small firm, so it really cuts down the time needed to get to positions that have a defined margin of safety. So as a term that I'm sure many of your listeners and the like know, where you really want to separate the price from the value, really invest when the value is underpriced.
We're definitely moving there that selectively right now.
Very quickly, yes.
Yeah. You have something unique. You offer a family office services, and you provide this valued service through a single point of contact, which is circumventing the bureaucracy. What motivated you to do that, and why is it so important?
Well, it goes to the name of the firm. Not a lot of, as you know, a lot of firms in this business are called, Miller Asset Management or whatever the case may be. And I wanted to put solutions on there because I do have a number of clients, actually a lot of female clients that are either widowed or divorced. And they either had a individual in their life before or need someone who can really handle not just the investments, but everything. Some of these women are very wealthy and have second homes, and I can be very helpful in the management of second homes. I've also managed private aircraft in terms of the leases and managing the pilots and the maintenance crews and everything that has to be done with those when you actually own, as opposed to net jets or wheels up. When you actually own your own aircraft, there are complications. So second homes, aircraft, boats. And the family office idea can be taken to even as simple as many of these women who I do business with, they have second homes in, say, Florida or Arizona, and I can be their ride to the airport, and they would much prefer discuss the portfolio as I'm driving them to the airport than sit down at the country club or somewhere public and discuss the investments, which maybe they're not that excited about. That's my world, to be excited about things and to really produce a return on their funds, as well as a return of their funds. But, they have found anything I do, including as simply as giving them a ride or helping them collect bids for resurfacing their asphalt or concrete driveway or redoing their pool, anything under that nature, under the umbrella, falls under my family office umbrella. And I don't charge extra for that. So I'm really there for any, and it's not limited to women, I'm really there for any needs that a client may have, however esoteric.
So you and your team will take care of those intimate needs of the family. It's cohesive, comprehensive, and it's got a personal touch to it. So that really is the family office business model, is
Yes.
trying to
It's
help manage that family and make sure that they really are enjoying life, and the investment side of it is, the cash flow is there to handle what they need long term.
exactly. It's a win-win. I do meet with multiple generations of family members at least.
Okay. Let's talk more about that. Go ahead.
So at least a couple of times a year, no more than two, I'd say.
Okay.
If you do it quarterly, it's a little excessive given where some other family members may live out of town.
Mm-hmm.
But at least on an annual basis, I try to get everyone together. They can both ask questions of me and ask questions through me.
Very good.
That is the nature when you bring different generations together. Is there are obviously tensions to some degree. There's a lot of love, but money and complicated instruments such as trusts and LLCs and often bring confusion and sometimes stress. And so I'm really just the conduit to help explain and diffuse any issues.
It's interesting because I've written 2 books on the subject matter you're bringing up. It's not about the investment side. It's about the family dynamics in a very high and ultra high family and how to raise and embrace the children to thrive and how entrepreneurship can play a role and being proud of the children, and giving them the tool set where you may write a check for $1 million, $5 million, give it to, our young adults and work with somebody with your caliber to help them deploy that money and look at the learning and the mentorship that takes place with a seasoned advisor.
Exactly.
And I think that's the strength, is that mentorship, that it's not going to happen on its own. A lot of the children don't listen to their parents. So somebody like yourself stepping into a role and you understand the vision of success for the family and the long pedigree of where the money was earned. It could be new money, it could be multi-generational money, but the next gen is really the future,
Yes.
empowering them to really take the initiative to look at the history of the family. How did the family earn these type of funds and the fiduciary responsibility they have multi-generationally? Because if we don't address it, they're probably the second generation, could be 60% of the funds could lost at that point. And in the third generation, it's about 90%.
Yes.
So you can see the role that an advisor in incentivizing and motivating the next gen to take a deep interest and, be part of that conversation. You're one of the first individuals I'm sitting, maybe the second. I have somebody in Germany that's managing $3 billion that I interviewed, where they're also looking at the dynamics within the family to really make sure that it's a wholesome environment and the learning, like a learning academy that's in place to help that young person feel that they're included in the decision-making that's taking place. And then at some point they would take over.
Precisely. And it really falls within 3 different realms for me, just for the next generation is charitable.
Okay.
Where the next generation, if they're obviously, a lot of these families are very wealthy, and if it's at this level, their daily needs are essentially taken care of,
Okay.
Whether through their own employment or through distributions from trusts and the like. But guiding some of the next generation on how to do charitable giving and philanthropic giving in an efficient and knowledgeable way.
Mm-hmm.
Not just giving, $10,000 to each nonprofit that asks them, as well as helping them understand their cash flow and then understanding what their children, i.e. possibly the fourth generation, the far-flung analysis, what their children should be thinking about and how any fiduciary instruments for their children are structured. So those are really the 3 main areas, and everyone cares about so it really is the past, present, and future, right?
Excellent.
That's what
we'll discuss the legacy of the family. And I think that's extremely important. What are the current trends you've seen in the general market currently or going forward? Any insights that you have?
So it's scary out there. There's no question, but people, I've referenced volatility and the VIX being very high. It's well above 30 today and usually in the neighborhood of 20. And I don't rely on a lot of technical indicators, but the VIX is a decent technical indicator to look at. And obviously the markets have been down. They've been down, over the last 5 days, about to the tune on average about 3% a day. So it's been a very volatile June. It's mid-June as we record this, and what I'm seeing obviously is no different than what a lot of people are seeing. Is that obviously energy is a good, safe place to be. We do have allocations to that through some of the standard refiners and oil producers such as Exxon, and then obviously the pipelines, Kinder Morgan, much like our railroad analogy, they are the railroads of the oil community, where they are just transporting oil and natural gas and the like all across the country in a spider web of pipes. Whether or not you like those pipes, and if they're in your backyard, I don't know, but they certainly are the most efficient way to get raw crude materials from A to B. So energy is obviously is a great place to be. Financials have been beaten up, but they will be just fine after the Fed has really gotten through the meat of their interest rate raises, which one is coming up tomorrow, whether it's 50 basis points or 75 basis points remains to be seen. But as there is more clarity, and after more and more of the federal meetings with interest rate increases have gone by, financials will become more and more appealing, and they're trading down. So that is the second area I would focus on. And then, the technology names, they have just been, the baby's been thrown out with the bathwater to some extent. I'm not talking about the famous FANGs, but I would say the second tier technology names, like Micron Technology is a provider of storage for your computers and your phones and every other corporation that relies on servers. So Micron is one of our key holdings, and it has really gotten beat up this year, but the future is gonna be storage, whether it's in the cloud or locally, and all that relies upon either DRAM or NAND storage, both of which Micron produces.
Very good. I appreciate you sharing your insights.
Sure.
Patience, we have volatility, it's very normal, and that's what your team is about, is pick up the phone, let's have a conversation, and we'll talk you off the roof.
Yeah, I mean, there's really, in terms of actionable plays, not necessarily security specific, but there's only 4 things you can ever do when risk is high. And you can take more risk, you can take less risk, you can do nothing, or you can go to cash. That's it. Those are the 4 things. And so we are on the side right now of deploying cash and therefore taking slightly more incremental risk.
Okay.
So I would say that over the last 30 days, we have implemented 1 position. And so our turnover averages around 5% a year.
Okay.
So 5 to 10% at the max. So this is a time of high activity for us, but it's and it may lead to further purchases as the market continues to revalue itself downwards. But I would say that, those are the only 4 things that people can do in the market: is take more risk, take less risk, do nothing, or go to cash. And so we're taking slight more risk.
Right. We'll know more in November.
Yes, we will.
We have an election
Absolutely.
coming up. I think there's going to be a change sitting in 2 of the houses.
That's right.
And
that should be, it should be bullish, actually.
I agree I believe it exactly what you're sharing.
Yes.
Is there anything I haven't touched on that you would like to add?
No, I mean, we are really an opportunistic manager that seeks to find the best ideas and implement them in the most responsible way. And so in the most responsible way, obviously comes to the timing of things, concentration of the ideas. Right now, as I've previously referenced, we are slightly adding to the portfolio and decreasing cash, and we're doing it in smaller allocations than I would normally. We do run a fairly concentrated portfolio of about 20 to 25 securities, and each position usually starts at around 2 to 4%. So we'll be starting positions in the 2% range to allow for any further downside. But all these positions have clear, really margins of safety And we really look to find some unrecognized value through the purchase of these securities, hopefully by the end of the year, if not before.
Okay.
So, and it can include anything in terms of, when I said opportunistic, we go anywhere in terms of market capitalization, whether large cap or small cap, locale, whether it's US or international, including emerging markets, and really any kind of market structure. So whether it's equities, preferreds, or debt. High yield debt is something we have considered in the past and may consider going forward as the yields go up and the price goes down. So that's something we're looking at right now, but have not yet implemented.
How can our listeners contact you? Are there any links you would like to share?
Sure. Thank you. I appreciate you asking. Cliff, this has been very enjoyable, and we can always be reached at 434-825-0000. My specific email is sean@millerasset.com. And then our website is just that, www.millerasset.com.
I want to thank you for your time, Sean. Your insights are so valuable to share with our listeners, and I appreciate it.
Thank you for your interest and the opportunity, Cliff. I really do appreciate it, and hope you have a great day.
I want to thank our listeners. I look forward to being back with you shortly for another episode of the Private Equity Profits Podcast. This show has been produced by Market Domination LLC.